All right. Welcome again, once again, weekly. We keep doing this every week. We can't stop. Freightonomics, 2 p.m. on Wednesdays, but it is going to change. We keep promising that it is.
It's going to change.
It's going to change.
An hour long, too.
Yeah. Welcome to Freightonomics this week. I'm Zach Strickland, Director of Freight Market Intelligence. Along with me, as always, Anthony Smith, Lead Economist, among other things at FreightWaves. Here to discuss the nature of the freight market and the global economy and how it all fits together.
That's right. And before we get too far into our show, we have to thank our sponsor, Amazon Freight, thanks to our sponsor at Amazon Freight, who knows you need more than anything than another truckload services provider. You need a partner who can help you navigate the world of logistics and plan for the future. Amazon Freight is helping shippers move their freight simply and reliably, while backed by the innovation and expertise that's in the DNA of Amazon. Whether you have a few truckloads to fill or thousands to move, Amazon Freight is your opportunity to put Amazon to work for you. Visit freight.amazon.com to get started.
Yes, thank you once again to our sponsors. We're always, of course, appreciative of them. So we've got a big show today, Anthony Smith. We always have a big show, but today we're going
flashback of wrestling.
Yeah. Welcome to the show. We got market expert Henry Byers, Lord of the Ocean, joining us today. He's going to give us some insight on what we're seeing in that maritime space. I wrote a chart of the week this past week. Got a lot of hits.
Yeah.
Got a lot of hits. I think my clickbait title was very effective.
You gotta employ some clickbait tactics from time to time, just to kind of get the eyes in. But they stayed and they commented, and you get a pretty solid viewership on those charts of the week.
Yeah, no, I mean, it does get a following. It gets plastered there on the front page of FreightWaves, and of course, very data-centric view of the world. We try to always support our views with the information at hand. Henry Byers, actually, him and Mike Bowden-Distel, I got to give shout out and credit to them for inspiring this week's chart of the week. So he's going to come on and give us a little bit more color, a lot more than I can ever do, for sure, here in a little bit. But up first, Anthony Smith, we have some stories.
We have some stories. I see we have big news from the White House.
Yeah, and I put this one in there because I really wanted your take on what this means. Joe Biden, of course, announcing a $1.8 billion package. Trillion dollar package. And largely going to be funded by none other than increasing taxes on the top tier of people in the United States, the wealthiest individuals. There's a long argument, and again, we always try to avoid politics. We know it exists.
I'm here for it.
Yeah, whether you're on the right or the right or the left side. Whoa! The right or the left side of the aisle. We want to present things in as clearly an objective view as possible. And I want to make sure that we do cover this as cleanly and objectively as possible. What is your? I don't know if you've seen any specifics on this bill. I haven't reviewed it myself, but the idea that, this trickle-down economics that we've all heard since the Reagan era, you don't want to tax the wealthy too much or the businesses too much because that's who gives the employment. And of course, taxes in general, economically speaking, not a great economic stimulator. Am I right or wrong?
Yeah, and I think when you're looking at taxes, it's one of those tools where a lot of times the government looks at it as an incentive or disincentive. And so when we're looking at taxes, especially when we're looking at how taxing individuals, it's going to make or influence certain activities or certain actions out of them. And so it's one of those many things when you're looking at economic policy. What's going to happen? You think you're going to expect one outcome, and then you're going to have a plethora of other outcomes happen. And I think this is very much so one of those things. And so when we're looking at this, I'm never a fan of more taxes or increased taxes on any party, or not any party, but any segment, whether it be a business or a corporation or a certain individual. I get, the common theme that when we're looking at overall taxation within certain groups, that more groups are taxed heavily than others, and maybe the most elite aren't as taxed at a higher rate. And there's an ability to kind of navigate those tax codes and things like that. So I understand that. But when we're looking at this, and this isn't even a party or a league that I'm going to be a part of, at this moment. You can all aspire to.
Yeah, neither of us are worried about this one.
Yeah, it's not going to impact my day-to-day life.
Not directly, at least.
Not directly.
Yeah.
But it's one of those things I'm not really a fan of because I feel like I won't say lazy economics, but in a sense, it's almost like a laziness. And so you have those incentives unintentionally when you do these types of taxes.
Yeah, I tend to lean in agreement with you here in terms of taxing things. You want to use that as not necessarily a way to generate revenue, but a way to influence movement in the economy.
Yeah.
And I think that's obviously in the long run, that's the more effective way of doing things versus just simply saying, you have too much, I'm going to take that from you.
And open up different streams. So we're looking at, it's not federal, but it seems like it might be federal at some point in time, but marijuana might be a thing. That might be a huge tax stream to fund.
The lottery is nothing more than a fun tax.
Yeah, and so they're opening up the streams rather than targeting others. But I mean, it seems like a broken system in a extent. When you have people that are able to lobby for their company or their corporation to kind of get a little bit lenient. And so there's a lot of areas and wiggle room where it could be kind of tightened in, honed in a little bit more before going for actual individuals.
Yeah, and obviously there's all sorts of levers. The granularity of this situation is more than we have time to discuss for sure, but appreciate the viewpoint there. The next story of the day, this one is, if you want a summary of the current freight market and what it means as a carrier or a brokerage, especially an asset-based brokerage, this article that Todd Maiden put up on FreightWaves yesterday, citing trucking tailwinds evident in first quarter 2021. This is a fantastic piece, covers like basically earnings season in a tight, compact nutshell from top to bottom, basically eradicating the idea that this winter weather event, which winter weather typically is a bit of a headwind for carriers out there in the space, it didn't have a big impact for most of the carriers or providers in the first quarter of 2021. Think about it. I mean, even though capacity is super tight, we're not necessarily seeing the volumes and carriers shut down for effectively a week in the middle part of the country. And then, of course, the downstream effect of that, of not being able to cover subsequent loads, shippers also shut down. So that just means less loads, less utilization for a period of time. But the fact that rates are so extraordinarily high right now, that was a moot point.
Yeah. And I mean, looking at this article, it deserves more views, in my unbiased opinion, because Todd really did a great job of not just breaking out this article, what's going on within the freight environment, but man after my own heart, he brought in economic data and kind of went into some of the macro movements when he looked at retail sales, inventories, and brought in manufacturing. He even cited some of the ISM data. So looking at how all these things are gaining momentum, looking at industrial production, actual tangible data sets, it hit positive.
Yeah.
So we're now in the positive manufacturing territory. And so that momentum has been, and it's been in play for a long time. It's been not the fastest growth segment, but growing nonetheless. And so across the board, we're seeing expansion, and that kind of feeds into what we're seeing within this nonstop freight market. And he breaks it down into every single component, and even going into, what the brokers are seeing, and seeing that brokers are seeing revenues per load soar. And so,
yeah.
Very well written article if you haven't checked it out already.
Yeah, extremely comprehensive article there. Well done, Todd Maiden. If you are interested in that, I definitely suggest you go check that one out on FreightWaves.com. So, without much segue here, the next story of the week, of course, my chart of the week, and this is where I want to bring our expert Henry Byers on, introduce him and get him going, and then I want to dive into really what inspired him. Basically he inspired me to write this piece, and cover this sector. But obviously, I would love to share his viewpoint and his expanded knowledge on this subject with the rest of the world. So let's bring on Henry Byers and get him set up. Henry, thanks for joining the show this week.
Hey, glad to be here, guys. Good to see you.
Yeah, man. So, a few weeks ago, you put this out on our internal Slack channel, this chart of the week, basically saying you've never seen a situation where the inbound empty containers were outperforming the inbound loaded containers. Now, these are international containers, 20 and 40 foot units that were essentially going to be going back across the ocean. Now, tell us why Yeah, there we go. Tell us why you think this is such a significant signal for the freight market moving forward.
Well, I think during this time period specifically, that amount of international containers traveling back empty into Los Angeles then loaded is just mind-boggling, and it really speaks to the container imbalance that's building, and why I say it's time to sound the alarm. Because if you have that amount of imbalance in international containers, it's not necessarily that there's not enough international containers; they're just in the wrong places. And I think as these volumes continue to build, continue to pour into the country, I think you're going to continue to see this imbalance just grow more and more and more.
Yeah, I think it's, especially somebody like myself who didn't even know this kind of information existed in the past. These are triggers for the domestic freight market that, these are far reaching downstream effects in terms of what it means for, internal freight movement. So, can you help us kind of understand a little bit of what you dealt with in the past in terms of repositioning these containers and getting freight back and forth between America and its trade partners?
Yeah, I mean, you got to think, due to the nature of international trade with the United States, we obviously have run a tremendous trade deficit. A lot of that trade, in those imports is done with China specifically. There's just not as much export freight going back to East Asia than there is coming here, obviously. So a lot of those containers do travel back empty. Especially right now when ocean carriers are receiving record revenue for these containers. It's not a wonder why they want to get those containers back over there quickly, because that's really, when you're talking about, like we are in truckload terms, head haul versus back haul. That's a tremendous head haul lane for them. So if those containers aren't on that trade lane hauling goods from East Asia to the United States, they're not earning the same amount of revenue. So when you're dealing with capacity, you're dealing with space on these vessels. Number one, you have to have a container before they can even get on the boat. So the containers are a critical piece of that capacity. So if there's just simply not enough containers, and those shipments are having to wait at the factories before they can even be picked up, you start to get these shipments, being backlogged at the shippers. They just continue to pile up while they're waiting on these containers. It's just a real nightmare for these ocean carriers, because they just can't get them back there fast enough. Those boats can only travel so fast. There's really there's only so much they can do to really speed those vessels up to get those over there.
Yeah, so one of the big storylines of the past couple of months is the fact the exporters are getting bypassed from the United States in terms of maybe some of these empty containers could be filled, but essentially the rate situation is so high coming back across the water from Asia that they're basically saying, no, it's not worth our time. How much of an impact do you think this is having with these rates being where they are right now?
It's having a tremendous impact on those exporters, and they've just come out. Lorianne LaRocco published on LinkedIn not too long ago a letter that they had actually shippers, really the export community here in the United States, had come together and has actually written a letter to the FMC, to the government, essentially asking for assistance, because they're literally oftentimes getting bypassed, and not given the opportunity, the same equal opportunity to get their shipments on those vessels. But then you have the fact that the U.S. does not really have a true ocean carrier that's capable of maneuvering those same trade lanes that these other international ocean carriers are when you're talking about containerized freight. So we don't have a company necessarily we can lean on to really kind of help provide that influence in the market, which leaves us further exposed. And it's hard to blame the ocean carriers in a breath, because this is the first time they've been earning these record revenues, and they're normally operating at a loss. So of course they're going where the money is. So it's kind of playing out in a real way right now.
So, Henry, as you just mentioned, there are a variety of factors going on right now, and it doesn't sound like it's at all sustainable. Do you see this coming to a head at any time in 2021, or is this something that you might see seeping into 2022 or for years to come?
Anthony, it's a great question. I think we would have to see this peak at some point here in 2021. Just the amount of, the number of data points that I'm looking at that are all-time highs is just mind-boggling. You have, import TEUs coming into the United States at all-time high. You have global container rates just off their all-time highs. You have rates from East Asia to the U.S. Really close or at an all-time high. And in many cases, the surcharges that these shippers are paying, I've heard reports of $15,000 per 40-foot container is not enough to get you a spot on one of these boats, which is really just mind-boggling. But I do think here in the next 60 or 90 days, we probably will see, just how bad this can get. And from there, it'll just be a tremendous ripple effect. And I think it will last into 2022, at least through Q1, through Chinese New Year. But it's really hard to foresee because we just have never at one time, just like the empty containers moved into Los Angeles, seen so many data points showing so much pressure being put on the system. And that's why I say we need to really sound the alarm, because this tsunami that's coming is going to be amazing to watch, see what happens.
Yeah, so if we could pull up the rates here, the Freightos rates, to show, just to illustrate where we are historically speaking. We're looking at the spot rate for a 40-foot equivalent moving from China to North America's east and west coast. So the east coast there, and the orange for the viewers out there. For those of you that can't see, obviously this is something that is available on FreightWaves and Sonar if you are a Sonar user. But you can see it's about $6,200 shipping a 40-foot equivalent to the East Coast from China right now, and it's about $4,800 to move something to the Los Angeles ports or any port along the West Coast there. Now that seems like a pretty big discount to ship something to the East Coast in relation to the West Coast, with the West Coast being so elevated right now. Do you think that, I think we've obviously seen a lot of shippers move their freight into the East Coast. Do you think that that's going to be a persistent pattern? Are we going to see continued rate inflation to this level? I mean, we were paying, what, $1,500, $1,600 just over a year ago in this lane, and now it's all the way up to $6,200?
So I think the movement of freight to the West Coast versus East Coast, I think at this point, Zach, that's almost come and gone, that time period. I think we're now at a point where it's get the freight here however it can get here, whatever container port that we have the resources and are capable of moving it through that container port, with some efficiency. I think that's what most importers are looking at this moment. So you're literally going to see the most evenly distributed, as far as import containers to you're going to see record highs at nearly every port along the East Coast. You're going to see record highs at nearly every port along the West Coast. Gulf Coast ports like Houston are going to be posting tremendous numbers, at least for the next 3 to 4 months. A lot of these ports are going to break monthly TEU import records for loaded containers. I think you're going to see most major portside markets, again, must be a container port, a port capable of handling these containers, be close to, if not surpass, their all-time highs for that month.
So, Henry, this kind of brings me into an area I know Zach was talking about it earlier, was the relationship between maritime and surface transportation. Now, where we're seeing that this shift and more activity on the East Coast, do you see this playing into some type of change in surface transportation?
Yeah, certainly. I think just like we just mentioned just a second ago about just how evenly distributed these container volumes will be. I think, over the last couple of years, we've seen kind of that shift Zach was referring to, where a lot of these importers are choosing to route to the East Coast. And a lot of that was lingering factors from the trade war and that tremendous pull forward of demand we had at the end of 2019, expecting that January 1st tariff. A lot of that was getting pushed to the East Coast, are getting more evenly distributed. But now you're going to be looking at ports that not just like Savannah and New York on the East Coast or Norfolk, you're going to be starting to see a lot more volume pouring into Charleston, Philadelphia, Baltimore, Jacksonville. So those portside truckload markets are also going to see a tremendous boost with outbound tender volumes. You're already seeing it in Seattle. You're already seeing it in Stockton, California, big warehousing market for the Port of Oakland. You're already seeing it in Ontario and Los Angeles. And you got to remember, these are already elevated volumes, from what happened last year and the tremendous volumes coming in. So just because there's not, 10, 20 more boats waiting off the coast of Los Angeles and Long Beach doesn't mean there's not a tremendous, really, record number of outbound truckload volumes still sitting in that market waiting to move out. I think you're just going to see tremendous numbers across all these major portside markets in the truckload sector.
Yeah, so do you think that there's going to be any kind of permanent fixtures that come out of this? I think everybody's kind of understanding that we're in this restocking event, unprecedented type situation. But is there anything that you can see, or at least getting word of or hints of, that these shippers are now starting to develop more long-term strategies versus just get the freight into the markets right now?
Hmm. Yeah. I think one of the biggest trends, in my opinion, that'll end up having an impact on the situation is primarily the transparency of the industry. I think with a lot of what we deal with, the disparate data sets that we're just trying to piece together what's happening in the market in real time. I think you're going to see that shift just accelerated by what's happened and what will happen. So I think there's going to be a lot of positives on that front coming out of this. As far as really the state of capacity in the market. If we get into an oversupply event, it could be quite massive if something were to happen on the backside of 2021 going into 2022 economically, where we see a substantial downturn in the market. You get in a case where we have a tremendous amount of too many containers, too much vessel space, the boats are too big. We're teeter tottering really on this really interesting fine line of so much demand at a really odd time with all these different factors coming together at once to create this elevated demand. And then, the supply trying to meet that demand could then end up having adverse consequences down the line. So it's going to be a really, like I said, this is wild times that we're in.
Yeah, it's kind of interesting to see this play out on the maritime space, which is traditionally relatively stable outside of a few hiccups that earlier in the decade. But I guess to your point, like, and Anthony, this is obviously your sector. Are we in such an overheated environment that we are inevitably going to see the inverse constriction event, like the deceleration is going to happen? We saw it in truckload in 2018, 19, coming off a super hot market, and then it was oversupplied, which had a huge deflationary impact on rates, and as well as capacity, which led us back once again to setting us up for having no capacity or not enough capacity. So this is almost like this roller coaster ride of capacity, no capacity, demand, no demand. Do you think that this event will end up, and I pose this to both of you, being a lot like that for both spaces, for macroeconomic and maritime?
You want to go ahead, Anthony?
Sure. So I think for on the macroeconomic side, Henry and I were chatting a little bit about it just a couple months ago, or earlier last month. We're looking at stimulus packages and how much can we inject stimulus into the economy before we start to see any kind of inflationary pressures really kind of come into play in a very significant way. And so when I'm thinking of that question, I'm also thinking of where our demand is and where our propensity to spend is. We just saw, I know you hate it, but consumer confidence just hit a pandemic high. And so consumers are feeling confident. We have a lot more money circulating throughout the economy, jobs, markets recovering. So I don't really see demand diminishing too much. Whether that demand is going to be on goods or services, or more services kind of begin to be more incorporated throughout the summer, that's going to be a thing. But looking at that, I don't really see too much of a swing back and forth. But it does have some worrying concerns, because we did see that imports of goods for the U.S. increased 6.8% in March. And so this is something very, very significant. And Americans are consuming and at a record pace right now, and much quickly than a lot of our trade partners can really produce right now, because we are having these aggressive vaccine efforts. We are seeing a recovery faster than our counterparts are right now. And so that's going to be one of the biggest things, is how far can we go and how far can we stretch our insatiable appetite for consumption before it just kind of comes to a head. And so I think that's what I see at the macroeconomic side. I'm sure Henry might have, I don't know, Henry, do you have different takes on the maritime side?
No, not necessarily. I think we're just dealing with something that's new to all of us. I think the pandemic has forced, like you could argue that the responses that the government has had, the Fed has had, have all been unique to this pandemic, and I certainly think we would all mostly agree in a lot of cases. So I think what the after effects of this type of stimulus are also fairly unknown. We have historical points of reference where we can look back and say, okay, we know at this point when the market was this heated, this happened. But we never knew that after a pandemic and the market was this heated, and there was this much demand from all these consumer changes, what that'll look like when it finally starts to cool off. But I think, what we've certainly seen is that as long as the government's willing to continue to implement a stimulus, and I think consumers are showing that they're willing and ready to spend on goods that ultimately are made overseas. So for the import side of the equation, I think that plays into it quite a bit. But if there's no more stimulus, things might tend to cool off a bit quicker. But if the government's willing to keep continuing to make deposits into consumers' bank accounts, I think they've clearly shown that they're quite willing to spend a significant amount of that check.
Yeah. So, we talked about this a few weeks ago. It was a show that unfortunately you couldn't join us on, but I'd be remiss if I didn't follow up here and ask if you saw any kind of fallout from the Suez Canal situation.
Not so much here in the U.S. I think one thing for U.S. importers that are importing from Europe specifically, they saw quite a bit, about a $1,000 increase on 40-foot container rates from North Europe to the North America, East Coast, West Coast. But besides that, I'd say the U.S. has fared fairly well throughout all of this. But I think for European shippers that are shipping from China, there's been more canceled sailings, more basically vessel rearrangements where some of that capacity is having to be reallocated in different ways. So therefore, it's put a lot of upward pressure on rates that were already close to record highs. So I think, those importers, you could say, importers from China to Europe, as if you're a European importer, they're seeing upward pressure just like we are on rates. And I think the U.S. won't, with what we're already dealing with in the form of congestion and delays at the ports, it was hardly noticeable, to be honest with you, in the data, because just so much volume travels on different trade lanes for U.S. importers.
Yeah, right. So, it was already congested and mess. One more little disaster wasn't really that noticeable. So one more question before I let you go. Where do you see the Freightos index rates a year from now?
That's the $1 million question, Zach. It's a $1 million question.
Because, I'm putting you on the spot.
Right now, okay, so I'm sorry, go ahead.
I was putting you on the spot. Bold call.
No. Basically, ocean rates work a bit different. It's not so much a perfect market in terms of, a certain amount of demand, a certain amount of supply. That's an equation to what ultimately ends up being the price you pay in the spot market for a 40-foot container. Right now, you're dealing with a case where they're so high, there's a tremendous amount of pressure being put on shippers back onto ocean carriers and NBOCCs to get those rates under control. So you're reaching a point now where, we could be seeing a ceiling of sorts because of the amount of just pressure that's happening internationally on these ocean carriers to control their costs. But I do think if demand, continues to have an impact, if that were the only thing going into this, right? Imports to the United States right now are predicted to go to another new to all-time high in the next 7 days. The upward pressure from a demand perspective is totally there. So if that's what's driving these rates, it's, because supply is basically going to stay the same, if not get worse, from the container shortage and the capacity shortage with the vessels waiting in line at these different ports. That's going to be a lot worse here in the next couple of weeks. If that's what's going to cause these rates to go up, you're certainly going to see new highs. But again, we're not necessarily, it's important to keep in mind, we're not necessarily working with a perfect market in terms of how those rates ultimately come to be.
Right on. So you think, obviously, we're going to see another peak here in the near future, more than likely.
I think so.
All right. Well, thank you so much for joining us, Henry Byers, market expert here and keeper of all things maritime, Anthony Smith.
Yes.
We always like to end the show with a little bit of a debate. Google Maps versus Apple Maps. Which one?
I'm not taking Apple on anything. Not a single thing. I'm going with Google Maps. And if I were to take it a step further, I might even go with Waze.
Henry Byers. Is he still there? No, he's not there.
Gone.
Okay. Well,
and Henry would say
no Apple Maps. I think we're all in agreement here. Me and my wife basically got into an argument over Apple Maps versus Google Maps the other day.
Was she on team Apple Maps?
She was on Apple Maps, and I have now berated her with me. Well, that'll do it, obviously, for this week's Freightonomics. Thank you so much for watching. Thank you to Henry Byers. Be sure to check us out on the FreightWaves TV app if you haven't downloaded it already. And everybody, have a great week.